as per my introduction, I've been doing this for a while, but let me go back to my first introduction into what we now call private equity. Does anyone remember the movies? Let me give you three movies, see if anybody remember it. The first one is The Dead Poets Society. Robin Williams, remember that movie? Yep. How about that Rick Moranis classic, now a Disney attraction, Honey, I Shrunk the Kids? All right? And finally, that probably one of Tom Hanks' central roles was Turner and Hooch. People remember those movies? Okay. So those movies were all part of a package that was created in the late 1980s into early 1990s called Silver Screen Partners. And the one I'm referencing is Silver Screen Partners 2. Those three movies plus about a dozen others were packaged together, and Silver Screen came to all the retail branches, frankly, in California. You know, I think it was back then it was Shearson Lehman Brothers and Payne Weber prior to UBS and Merrill Lynch and, you know, some of the predecessors to Wells Fargo Advisors. And they said that for a mere $100,000, your clients can participate in these movies. And the deal was, you give them a minimum $100,000, the first thing they would do with the domestic box office receipts. The domestic box office receipts was they're going to pay you your $100,000 back. Then after that, they're going to provide you with an 8% preferred rate. And then after those two things had occurred, you could share your windfall with the general partners 80-20, okay? And in that era, they were all called limited partnerships, kind of in the retail world. The next one that came up, and this was into the 1990s, some general partner had bought a chunk of land north of Phoenix, Arizona, east of the Salt River, and against mountains and airports and things like that. And they were offering it to the public, again, as what we called then a limited partnership, same minimums, same pref rate, and as the developers sold off the lots and all the accounting was done, that money would go to the investors. First you'd get your principal back, then that 8% pref rate, annualized, right? Not just 8%, but annualized, and then the 80-20. That was kind of my introduction to what we now call private equity and ultimately private debt, which is what we're going to really talk about over the next 20, 30 minutes. Does everyone remember where the term accredited investor came from? When was that first mentioned in regulations and in law? Securities Exchange Act of 1933. So it said that there's a certain class of investments that only the more sophisticated and more educated investors could participate in, and they had to be accredited investors, which was, I think everyone knows this, you had to have $1 million net worth. This is 1933, mind you. $1 million net worth or $200,000 a year in income. That made you an accredited investor in 1933. Anyone, any idea on what those amounts are now? Exactly the same. So despite the fact that that million is now 25 million, it's exactly the same. Now, when Trump got into office and all those executive orders, part of that a bit of noise was something that was really initiated in the House, not so much in the White House, but the House, which was H.R. 3348. And the focus of H.R. 3348, and this is kind of part of the selection of the accredited investor stuff, the focus of that was, in addition to the financial requirements, H.R. 3348 is trying to input some type of accreditation and some type of education to folks who aspire to be accredited investors and get more advanced, sophisticated types of investments. Okay. Anyway, so circling back to where this began, in the 1990s, what we in the retail side were offered was this whole group of what were known as limited partnerships. Something changed in 2002 to make that class of investments that were only allowed to be for accredited investors to take off. Something happened and they exploded. Everyone in here knows what this was, right? Sarbanes-Oxley. Because of Sarbanes-Oxley, companies delay and delay and delay because of the accountability, because of the paperwork, and it keeps a lot of the people in this room employed, quite frankly, all the analytical work that is required to go public now. So from 2002 with Sarbanes-Oxley through until now, what you've seen occur is that companies have delayed when they've gone public. My two best examples, PayPal goes public and creates the PayPal Mafia, which we're coming back to tomorrow. PayPal goes public and they raise a whopping $70 million in 2002. Airbnb goes public in 2020 and they raise $47 billion because everyone is delaying their public offerings. Michelle and I were just talking about this. SpaceX, the likelihood is it goes public tomorrow, 1.75 trillion per the revised S1. So the point is that you can get VC rounds, you can get private equity rounds, but why go public? Why have the disclosures and why deal with anything like that, okay? I think everyone knows the next slide, everyone's dealt with the next slide, the traditional J curve, right? So my experience with private equity, which I've been dealing with for, certainly as an investor for a decade or so now, is the traditional version of private equity is the first 3 or 4 years are the fundraising cycle. The GP, the general partner, goes out and they sign up as many investors as they can, and those investors make a commitment to contribute capital to their fund. And then over the next 3 or so years, the general partners go about the business per their prospectus of buying particular companies that fit what they're trying to accomplish, and they do the capital calls, and that's how the fund is created. Then, over the next 3 or 4 years, give or take, that's when they start working on the company structure. They add a more sophisticated IT program. They bring in marketing. They bring in better experts other than mom and pop who've run the business. They cut down particular divisions. They add new divisions. They combine companies, because what they're trying to do is go from 1x value to 2x value. That's during that second phase. Then, and my experience is that in most of the documents that I've been exposed to, what the GP says is 10 years plus 1 plus 1. What my experience is, it's 12 years in every case, because the incentive for that general partner, that portfolio manager, is to hold on to that asset until they find just the right valuation, because it's up to them. So anyway, this is the traditional J curve of private equity. Now what do we get out of this that we don't get out of public markets? So, and for those of you who want to track this down, I have about 4 different studies in the bottom right of this slide that feel free to look at. But what the goal is to see something about a double in 3 to 4 years. But really, if you do like those who have created these studies, it ends up being about 200 to 300 basis points above public markets that you achieve in exchange for that illiquidity premium. You're giving the money up. It's not coming back to you until the distributions happen, until there's liquidity events. And in exchange for that, the expectation is the returns are going to be higher than owning publicly traded securities. That is what we're trying to accomplish on this. Okay, so that's the profile, and that distribution period, in my experience, lasts a long, long time. I continue to, I'm going to tell you a couple sad stories in a second. I continue to get information from and dribs and drabs of cash from private equity deals that I was involved in the early 20-teens. They last a long time in so many cases. There's a long tail in so many cases. Okay. Now the other side of this slide is the gray. So what began as a very nascent product after Dodd-Frank became a big deal. And that was the private credit market, because of Dodd-Frank, banks couldn't lend. With rare exceptions, banks could not lend to private equity and in some cases venture capital, but let's just keep it with private equity. So in absence of bank lending, private equity firms, when they needed to borrow money, would go for private credit. So my two sad stories. I had a client, sadly he's since passed away, who in 2016 was about to retire. He was a neurologist, he was about to retire. We had a meaningful amount in fixed incomes, and he was dead certain that the interest rates were going to go up and the bond market was going to have problems. So what we chose to do was sell $2 or $3 million worth of fixed income, municipal bonds, I think in his case, and take that money and put it into several different private credit funds. So there are two sad stories associated with. Sad story number one is the gentleman passed away in 2020. Good client. It was a loss. Sad story number two, though, was that his successor trustee was his very unsophisticated sister who really wanted nothing to do with this stuff. So I had changed custodians since then with the sister involved. And what I learned from this was that private equity and private credit firms spend a lot of money on finding portfolio management, a lot of money on that. They spend less, but still a significant amount of money on marketing. And they spend a little teeny bit of money on administration. So it literally took 2 years to just simply change the title from the one trustee to the second one, because no one wanted to take our calls, no one wanted to help us out. It was awful, because she kept asking and we couldn't get anything done. And in many cases, larger private credit firms, and most likely private equity firms, would outsource that administration to a third party. And the third party we were just a number. I mean, there was no high touch at all in it. So that was really kind of one of my moments where I questioned whether I want to have anyone over about the age of 65 get involved in traditional private equity, private credit, because by the time they got to an age where I think their lifespan was vulnerable, I didn't want to have to deal with these kinds of things with their heirs. Okay, so that's sad story number one. And it's all about administration. Same with sad story number two. As I said, I had changed custodians, and my new one of the private credit deals I had was a feeder fund that was exclusive to the previous custodian. So I came up with this great idea. Let's just, they say it's liquid every quarter. Let's just methodically get all the money out. Well, everyone has probably fresh memory of the gating fiascos of the first quarter of this year with several private credit firms. It took 2 years because they would just give us a little bit of money every quarter, and they made us do totally new paperwork with different questions every quarter. So they just kind of slow walked us through it. So those were the sad stories that I dealt with traditional, in that case, private credit, okay? The other thing, though, that we got to pay attention to with private credit fundamentally, though, is, are they direct loans to the private equity firms? or are they purchase loans? How much leverage is there? What's the tenor? What's the liquidity, if there's any liquidity at all? So the issue with the J-curve is this is at least 10 plus 1 in terms of time. It's a long time illiquidity. You get better than public rates of returns. Likewise with private credit, the original funds I invested in, it was a long period of time. Frankly, I'm involved in several of them right now, and I got them during the pandemic, and that's kind of when, before the Fed dropped interest rates into the basement, and those things have worked out really well. But there's a timing dimension to this, okay? So what has been done in our world now to deal with the timing dimension of this? What has been done is the creation of so-called evergreen or perpetual funds. This lends itself to a completely different story that I'm going to talk about in a couple slides, but purely by coincidence, I don't know if you guys know this, but this talk has been postponed a couple times, and purely by coincidence, I was in Newport Beach last Thursday at an LPGP conference, and it was primarily institutional investors. I went just because I needed a couple nuggets of information at the meeting. And when I asked the question to one particular panel of private equity institutional investors, do they ever use perpetual funds? And the answer was almost a snooty no. I mean, CalPERS is not going to use evergreen funds. The other one was the LA County employees are not going to use. They're not going to use evergreen funds. So let's kind of break down the difference between the traditional private equity and private credit and the evergreen funds. Okay, so traditional private equity, very high minimums. And I've seen them 5 million and I've seen them 1 million. Within wealth management, at least at the firm I was at, they would take it down to 250. I mean, it was more expensive at 250. They take it down to 250, but relatively high minimums. The illiquidity premium existed on the panel discussions I was involved in last week. There were several general partners who would be open to, with large groups, having customized structures, but primarily it's the 10 plus 1 plus 1. Thematically now, we're going to talk about things where private equity sponsors are trying to attract assets that aren't necessarily all institutional, okay? So institutional minimums on private equity are relatively high, okay? I'm a GP. I want to raise capital. How else can I do it? What has occurred is, if you go back to this, the slide on the evergreen funds, what's occurred is there are evergreen or also known as perpetual funds. They are business development companies, they're BDCs. Those funds have minimums that are $25,000. So they're relatively low minimums. They showcase quarterly liquidity. Now again, we had some gating issues with a few different private credit funds earlier this year, as well as my PTSD example of the one that I dealt with. The quarterly liquidity is there, but they want to, they're not interested in you doing quarterly liquidity unless you have to, okay? Where is my buddy Thomas Zambi? No, he's not in here right now. Where I have issue with the evergreen funds is in two areas, okay? Because they have quarterly liquidity, they got to carry cash. And if they're carrying cash, that cash they're carrying can't be invested. So there is a bit of a performance drag that's generally known with the evergreen or perpetual funds. The second thing I think is more important. So when I first started prepping for this talk, I asked 4 of my friends that are valuation folks, I said, all right, with traditional private equity, it's transaction-based. You buy it for X, you hope they sell it for 2X, and you reap part of the reward on that. But with evergreen funds, it is accounting-based. Every quarter, either in-staff accountants or outsourced accountants, valuation experts rather, will go and tell you what they believe the value of that company is. Thomas, who works here, who's the one that got this facility for me, was the first one of 4 that said, there's some gray area there. And depending on a variety of circumstances, it's not going to be a legitimate transaction. It's going to be what they think the value is. So if I'm in an evergreen fund and I exit an evergreen fund, the returns I'm going to get are a little bit more suspect because they're not based upon a transaction. They're based upon a valuation issue. So my point is that private equity is, in fact, accessible to all of you guys as individual investors, so long as you can find something that the minimums you have you can live with, and you have a long-term time horizon. Evergreen funds will always be available to you, but I'm suspect. Pay a lot of attention to the documents on how they're going to come up with their valuation metrics. What has happened in the past in their valuation metrics? What kind of cash do they keep on the balance sheet? Because those things are going to affect your long-term performance on things like that. Okay, so those are the changing issues with accredited investors that involve both institutions and individuals. I'm going to shift the subject to defined contribution plans. Okay, so let's be honest. Defined contribution plans, I think you guys all know this, are 401ks. Profit sharing maybe, but certainly 401ks where you guys and I am putting my own money into my own plan. It's not the company doing it, it's me doing it, okay? And again, one of the first things that happened with the administration is we're going to democratize alternative investments and we're going to allow them in 401ks. And my message is, not so fast. So everyone remember everyone knows what ERISA is, Employee Retirement and Security Act of 1974. Everyone remember what caused ERISA? What caused ERISA was these 3 entities, Studebaker, American Can, and the Teamsters, their pension funds that they were going to pay their employees when they retired for life were poorly invested. They lost all the money. So those pensioners got left out, okay? So now what we're trying to do by democratizing, putting alternative investments in 401ks, is we're now going to make the participants make decisions where the sophisticated investors within the company didn't do such a great job in the 1960s, okay? Any guesses here on what the average size of a 401k plan is in America? Any guesses? You will be surprised, because I was too. The average size is between $1 and $10 million. It's not these big Fidelity plans and these big Vanguard plans. It's the small businesses that do 401k plans. I deal with these things all the time, and in all honesty, I am not so wild about the trustees that I work with on a regular basis making decisions on whether or not to have some version of private equity or private credit in their plan, okay? So what are their requirements? Their requirements are to act in the participants' interests. In many cases, it's primarily them who are the participants. Select and monitor the investments. Now, this is working class America, folks. I don't know that I want to put them in the position or the investment platforms they use, Voya, Principal, John Hancock, to make those kinds of decisions on these long-term investments. One of the terms in diversification of investments too, one of the terms that I would use back in the day when I was competing for these types of plans was, all right, the trustee has a fiduciary responsibility, and if they make a mistake, the Department of Labor is going to come and do an audit. Well, what did I discover in the research for this? Far less than 1% of any plans are audited in the United States. So really, my message on this is, maybe not so fast. The other point I'll make, let's give a scenario. Okay, so I am the trustee of a 401k. I fall in love with, or my platform falls in love with, a traditional type of private equity fund. It's done well. The company has a consistent track record of doing really well. But again, remember our J curve, our 10 to 12 year J curve. So one of my employees says, oh, I love those returns, boss. I'm going to invest in this right now. And they start putting their monthly contributions into this private equity deal within the 401k, right at the beginning. 5 years later, this is not that uncommon. They retire, they get laid off, they die. That money's not coming out anytime soon. So I'm very, very wary of the idea of having plans in 401ks. Okay. All right, I'm shifting the subject a little bit. We're almost done here. I'm shifting the subject. So let me give you a scenario with something a little bit more unique in terms of alternative investments. We all work for a private company, and it's growing like gangbusters. So our executives decide that we want to incentivize all of us to stay around. So what do? They create options, not restricted stock, but they create options that when there's a liquidity event for our company, we're all going to make bank on it. And a couple years goes by, and our company's doing great, but several of us get recruited to go somewhere else. Do we get anything back from those options we were awarded? We get nothing back. So, how about if there were an intermediary that could allow me as an outside investor, could enable me as an outside investor to buy some of the options off of those employees when they leave? I, as an investor, have, quite frankly, and we'd be intrigued with that because that's, frankly, another version of an alternative investment. So to finish this up, I have one ask and one offer. So I like doing this talk. Dominic and I began talking about this back in the spring. I want to do this same talk across other institutions, both the other CFA society chapters in California and elsewhere. That's why I have the videotape going, is to videotape it so I can show it to other people. If you hit that QR code, it'll take you to a questionnaire. And the questionnaire essentially says, did you like the talk? Is there any other organization that you think may be interested in the talk or something like it? And it gives me a little bit of feedback. If you would be kind enough to, and it's a very easy questionnaire. If you'd be kind enough to hit that questionnaire, answer it, I will send you a copy of the book I published in 2022 called The False Hope of Global Diversification. And essentially, in a nutshell, global markets are very, very much correlating with one another. So the idea that we need to have global diversification to get a diversified portfolio is something that we kind of haven't had to do since the 1990s. And the book talks about it a lot. If instead you'd like to have a hard copy of it, I'm happy to give it to anybody who's here. And I would ask the courtesy of talking into my phone and giving me a little bit of a feedback on how the talk went to you. So I'm happy to give you the ebook copy. I'm happy to give you a hard book copy. And with that, any questions, anybody? Thank you very much.